Hi everyone! Today we will discuss the topic about commercial banks industry overview. But before that, let's define what is commercial banks. Commercial banks represent the largest group of depository institutions measured by asset size. They perform functions similar to those saving institutions and credit unions. They accept deposits and make loans. The term commercial bank refers to a financial institution that accepts deposits, offers checking account services, makes various loans, and offers basic financial products like certificate of deposit and saving account to individuals and small businesses. Commercial banks are an important part of the economy. Not only they provide consumers with the essential services, but they also help create capital and liquidity in the market. This entails taking money that their customer deposits for their savings and lending it out to others. So now, let's proceed to the brief introduction to the commercial bank industry balance sheet. A balance sheet or statement of financial position is a financial report that shows the value of the company's assets, liabilities, and owner's equity on a specific date, commonly at the end of accounting period. Assets of the commercial banks includes cash, securities, loans, and property and equipment that allows it to operate. While loans are the main revenue-generating assets for the banks, and investment securities provide banks with liquidity. Commercial banks and other financial institutions are exposed in high level of liquidity risk. Liquidity risk is the risk that arises when a financial institution's liabilities holders, such as depositors, demand cash for a financial claims they hold with a financial institution. When it comes to liabilities, commercial banks have two major sources of funds. First is deposits. Deposits are like that in that it is the money that the bank owes to the customers. And the next one is the borrowed or other liability funds. Commercial bank equity capital consists mainly of common and preferred stock, additional paid-in capital, and retained earnings. Regulators require banks to hold a minimum level of equity capital to act as a buffer against losses from their on and off balance sheet activities. Commercial banks engage in other fee-generating activities that cannot be easily identified from analyzing their on and off balance sheet accounts. Two of these includes trust services and correspondent banking. Trust services is the trust department of a commercial bank, holds and manages assets for individuals or corporations. Only the largest banks have sufficient stock to offer trust services. Individual trusts represent about one-half of all trust assets managed by commercial banks. These trusts include estate asset and asset delegated to bank trust department by less financially sophisticated investors. Pension funds assets are the second largest group of assets managed by the trust departments of commercial banks. Next, we have correspondent banking. Correspondent banking is the provision of banking services to other banks that do not have the staff resources to perform the services themselves. These services includes check clearing and collection, foreign exchange trading, hedging services, and participation in large loan and security insurances. There are different types of bank. We have community bank. It is a bank that specializes in retail or consumer banking. Retail banking. It is a consumer-oriented banking such as providing residential and consumer loans and accepting smaller deposits. Next, we have wholesale banking. It is a commercial-oriented banking such as providing commercial and industrial loans funded with purchase funds. And the last one, we have regional or super-regional bank. It is a bank that engages in complete array of wholesale commercial banking activities. Later on, we will provide a detailed description of the regulation governing commercial banks and their impact in the banking industry. But for now, we will describe briefly the regulators who develop, implement, and monitor these regulations. Unlike other countries that have one or sometimes two regulators, U.S. Bank may be subject to the supervision and regulation of as many as four separate regulators. These regulators provide the common rules and regulation under which banks operate. They also monitor banks to ensure they abide to the regulation imposed. First, we have the Federal Deposit Insurance Corporation. The Federal Deposit Insurance Corporation is an independent agency created by Congress to maintain stability and public confidence in the nation's financial system. The FDIC ensures deposit, examines, and supervises financial institutions for safety, soundness, and consumer protection. They also make large and complex financial institutions resolvable and manages receiverships. Second, we have the Office of Comptroller of the Currency, an independent bureau within the United States Department of the Treasury that was established by the National Currency Act of 1863 and serves to charter, regulate, and supervise all national banks and thrift institutions and the federally licensed branches and agencies of foreign banks in the United States. The third one is the Federal Reserve System. It was created by the Congress to provide the nation with a safer and more flexible and more stable monetary and financial system. And the fourth one, we have the state authorities. State authority banks may choose to be state chartered rather than nationally chartered. State chartered commercial banks are regulated by state agencies. State authorities perform functions similar to those the OCC performs for national banks. Financial institutions compete not only with other domestic financial institutions for a share of these markets, but increasingly with foreign financial institutions. This will achieve through international expansion. In international expansion, we have advantages and disadvantages. First, we will tackle the advantages of international expansion. Risk diversification. As with domestic geographic expansion and financial institution activities potentially enhance its opportunity to diversify the risk of its earning flows. Often, domestic earnings flows from financial services are strongly linked to the state of the domestic economy. Therefore, the less integrated the economies of the world are, the greater is the potential for earnings diversification through international expansion. Next, we have economies of scale. To the extent that economies of scale exist, and financial institution can potentially lower its average operating cost by expanding its activities beyond domestic boundaries. The third one is innovation. A financial institution can generate extra returns from new product innovation if it can sell such services internationally rather than just domestically. For example, consider complex financial innovation such as securitization and options that financial institutions have innovated in the United States and sold to new foreign markets with few domestic competitors until recently. The fourth advantage of international expansion is the fund source. International expansion allows a financial institution to search for the cheapest and most available sources of funds. This is extremely important with a very thin profit margin in domestic and international wholesale banking. It also reduces the risk of funds shortages in any market. Customer relationship. International expansion also allow a financial institution to maintain contact with and service the needs of domestic multinational corporation. Indeed, one of fundamental factors determining the growth of financial institutions in foreign countries has been parallel growth of foreign direct investment and foreign trade by globally oriented multinational corporations from the financial institution home country. The next one is regulatory avoidance. To the extent that domestic regulation, such as activity restriction and reserve requirements, impose constraints or taxes on the operation of a financial institution. Seeking low regulatory, low tax countries can allow a financial institution to lower its net regulatory burden and to increase its potential net profitability. In contrast, international expansion has three major disadvantages. First is the information or monitoring costs. Foreign activities may also be riskier for the simple reason that monitoring and information collection costs are often higher in foreign markets. For example, Japanese and German accounting standards differ significantly from generally accepted accounting principle that the US firm use. In addition, language, legal, and cultural issues can impose additional transaction costs on international activities. A truly financial institution must master the various rules and regulations in each market. Next, we have nationalization expropriation. To the extent that a financial institution expands by establishing a local presence through investing in fixed assets, such as branches or subsidiaries, it faces the political risk that a change in government may lead to the nationalization of those fixed assets. Fixed costs. The fixed cost of establishing foreign organization may be extremely high. Example of fixed costs include rental lease payment, salaries, insurance, property taxes, interest expenses, depreciation, and potentially some utilities. So I guess that's all the coverage of commercial bank industry overview.
Hello there, this is the part 3 of commercial banks, the financial statements. So in this chapter, we will discuss the 4 major categories of assets on a commercial bank's balance sheet to distinguish between core deposits and the purchase funds. 3. Identify off-balance sheet activities that a commercial bank undertake. 4. Is to describe the major categories on a commercial bank's income. And the last is to examine ratios that can be used to analyze the commercial bank. So let me introduce to you the financial statements of commercial banks. So sinasabi lang na ang financial institutions or financial information on commercial banks is reported into 2 basic documents. First is the report of condition, or also known as balance sheet, that reporting information at a single point of time. Second is the report of income. So dito, in terms of commercial banks, it serves as the income statements, that reporting revenues, expenses, net profit or loss, and cash. In Webster Financial Corporation and Bank of America Corporation, they use 2 financial services holding companies to evaluate the performance of commercial banks. First is the retail bank. It is a bank that focuses its business activity on consumer banking relationships. Second is wholesale bank, a bank that focuses its business activity on commercial banking relationship. So, pababawin natin ang definition para mas klaro sa atin ang difference nilang dalawa. So, from the word retail, so ihalin tulad natin sa isang sari-sari store. So, yung retail bank is parang katulad lang ng sari-sari store na kung saan na-engage lang siya sa mga single customer or individual consumer. Kasi di ba kapag ka sinabi sa sari-sari store, yung mga consumer lang nun is mga simpleng tao lang, kumbaga ang mga namimili lang dun is namimili sila sa isang tindahan para sa personal na pangangailangan nila, which is yun yung sinasabi na for individual consumer lang. While naman dun sa wholesale bank, tulad natin siya sa mga wholesaler na tindahan like supermarkets, for example, yung SM, mga Laswerte, ganon, mga wholesaler nga na tindahan, which is yung mga consumer nila dun is yung mga businessman din, mga ganon, mga nakaka-transaction din nila is mga business.
Wholesale banking refers to banking services for merchant banks and other financial institutions.
Some retail banks offer similar services for the individuals and smaller businesses they serve,
but
but
wholesale bankers work on a much larger scale.
They
They
offer
currency
conversion and working capital,
and they
and they
facilitate large transactions for banks and corporations.
They can consult on investments and provide underwriting services as well. A
A typical customer of a wholesale bank might be a large grocery chain operating many stores throughout a region.
The
The
chain could need checking accounts for each site,
as well as a large line of credit and credit card services.
A
A
wholesale
bank is best able to meet the chain's needs.
Many
Many
wholesale
wholesale banks
offer
offer
their customers discounts for bundling services. It's also easier for businesses that buy and sell properties and assets
to keep their financial information in one place.
One
One disadvantage to wholesale banking is the risk of keeping large amounts of cash in one bank.
The balance sheet structure. So, balance sheet structures contains asset and liabilities. So, in assets, bank assets are grouped into 4 subcategories. First is the cash and due from depository institutions. 2 is the investment securities. 3, loans and leases. 4, other assets. So, unahin na natin yung first subcategories ng asset, which is the due or cash and due from depository institutions. So, in these categories, vault cash is composed of the currency and coin needed to meet customer withdrawals. Deposit at the Federal Reserve are used primarily to meet legal reserve requirements, to assist in check clearing, wire transfer, and the purchase of sale of treasury securities. And deposit at other financial institutions are primarily used to purchase services from those institutions. These banks generally purchase services such as check collection, check processing, Fed funds, and investment advice from correspondence bank. Cash items in the process of collection are checks written against accounts at other institutions that have been deposited at the bank. So, meaning to say, pag sinabi lang cash and due from depository institutions, ito yung assets ng banks, kung saan ito yung currency o yung mismong coins o pera na dumadating sa isang bank. Next is the investment securities. Investment securities consist of federal funds sold, repurchase agreements, U.S. Treasury and agency securities, and mortgage-backed securities and other debt and equity securities. So these securities generate some income for the bank and are used for liquidity risk management purposes. Investment securities are highly liquid, have low default risk, and can usually be traded in secondary market. Banks generally maintain significant amounts of these to ensure that they can easily meet liquidity needs that arise unexpectedly. However, because the revenue generated from investment it is low compared to that from loans and leases. Many banks attempt to minimize the amount of investment securities they hold. So, simple lang investment securities. Naka-include din sa asset ng banks yung investment securities which is mga investment ng mga consumer or customer clients. Next is the loans and leases. Loans and leases are the major assets on a bank's balance sheet and generate the largest flow of revenue income. However, these items are also the least liquid asset items and the major sources of credit and liquidity risk for most banks. Loans are categorized as commercial and industrial loans, secured by real estate, individual or consumer loans, and other loans. Leases are used as alternatives to loans when the bank as owner of a physical asset allows a customer to use an asset in return for periodic lease payments. So next is the commercial and industrial loans. Loans are used to finance a firm's capital needs, equipment purchases, and plant expansion. They can be made in quite small amounts, such as small businesses or large businesses. Next is the real estate loans. Real estate loans are primarily mortgage loans and some revolving home equity loans. For banks, residential mortgage are the largest component of the real estate loan portfolio. Recently, however, commercial real estate mortgages have been the fastest growing component of real estate loans. Next is the consumer loans. Consumer loans, a third major category of loans, is the individual or consumer loan. For example, personal and auto loans, commercial banks, financial companies, retailers, savings banks, and gas companies also provide consumer loan financing through credit cards such as Visa, MasterCard, and proprietary credit cards issued by companies such as Sears and AT&T. Other loans include a wide variety of borrowers and types such as loans to non-bank financial institutions. So next is the liabilities. A bank's liabilities consist of various types of deposit accounts and other borrowings used to fund the investment and loans on the asset side of the balance sheet. Liabilities vary in terms of their maturity, interest payments, check writing fee privilege, and deposits insurance coverage. So types of liabilities. First is the deposits. Deposits items are transactions account held by individuals, corporations, partnership, and governments that pay no explicit interest. Corporations are prohibited from using deposits other than demand deposits. From transaction account purposes, this group therefore constitutes the major holders of demand deposits. Second is the borrower funds. The liabilities described above are all deposits liabilities, reflecting deposits contracts issued by banks in return for cash. However, banks not only fund their assets by issuing deposits, but borrow in variation markets for purchase funds. So next is the other liabilities. Banks also list other liabilities that do not require interest to be paid. These items consist of accrued interest, deferred taxes, dividend payable, minority interest, and other miscellaneous claims. And lastly, the equity capital. The bank's equity capital consists mainly of preferred common stock, surplus or additional plus-in, and retained earnings. Regulations require banks to hold a minimum level of equity to act a buffer against losses from their own and off-balance sheet assets. So next is the OBS. OBS stands for off-balance sheets. So what is OBS? OBS is items. So next is OBS. OBS stands for off-balance sheets. So OBS items are termed for assets or liabilities that do not appear on company's balance sheet. Although not recorded on the balance sheet, they are still assets and liabilities of the company. Off-balance sheet items are typically those not owned by or a direct obligation of the company.
Assets or debts that a company excludes from its balance sheet are off-balance sheet items. Usually, those are items for which a company has no legal claim or responsibility. A common off-balance sheet item is an operating lease. For example, Bob's business needs trucks to ship inventory to and from its warehouse. It does not want the cost of the trucks on its balance sheets, so it creates a subsidiary company that buys the trucks and then leases them to Bob's. Bob's only has to record the lease payments on its balance sheet, making the delivery trucks an off-balance sheet item. Another example concerns how a bank handles loans. Say Bob's business borrows $1 million from a bank to build a new warehouse. The bank decides to securitize Bob's loan payments, or transform those payments into investments, and sell those investments. The original loan would have to be on the bank's books, but the securitized debt is not. Investors use balance sheets to evaluate a company's financial health. Some companies may have large assets or liabilities among their off-balance sheet items, which may be of great interest to investors who are considering buying their shares. Because of this, investors need to consider the completeness of any financial statement.
So under the OBS, we have the loan commitments. These days, most commercial and industrial loans are made by firms that take down prenegotiated lines of credit or loan commitments rather than borrow cash immediately in the form of spot loans. A loan commitment agreement is a contractual commitment by a bank or another financial statement such as an insurance company to loan to a customer a certain maximum amount. Next is the commercial letters of credit and standby letters of credit. In selling commercial letters of credit and standby letters of credit for fees bank add to their contingent future liabilities. Commercial letters of credit are widely used in both domestic and international trade. For example, they ease the shipment of grain between a farmer in Iowa and a purchaser in New Orleans, or the shipment of goods between a U.S. importer and foreign exporter. The bank's role is to provide a formal guarantee that payment for goods shipped or sold will be forthcoming regardless of whether the buyer of the goods defaults on payment. So next is liens sold. Loans sold are loans that a bank has originated and then sold to other investors that may be returned to the originating institutions in the future if the credit quality of the loans deteriorates. We discussed the types of loans that bank sells, their incentives to sell, and the way in which they can sell them in more detail in Chapter 24. And next is the derivative contracts. Derivative securities are the futures forward, swap, and opinion positions taken by a bank for hedging and other purposes. We discussed a tremendous growth or derivative securities activity in Chapter 11. So banks can be either users of derivative contracts for hedging and other purposes or dealers that act as middlemen in trades.
Derivative is a contract between two or more parties that is based on or derived from an agreed upon asset. The parties included in the derivative decide what the asset will be. Common assets are stocks, bonds, currencies, interest rates, and commodities. Originally, derivatives were used to ensure a balanced exchange rate for goods traded internationally. For example, a U.S. company sends a shipment of goods to the U.K. The U.S. company would create a derivative with an investor that guarantees the exchange rate is equitable to all parties. If the exchange rate dips and the investor in the derivative speculated that the exchange rate will remain stable or in favor of the U.S. company, the investor would lose money. However, the U.S. company would still be paid the value of their goods. If the exchange rate rose, the investor would make a profit from the speculation, and the U.S. company would be paid the value of their goods. Today, many corporations use derivatives to gain favorable interest rates on loans to better manage corporate debt. This gives corporations more borrowing power for growth and investment. However, derivatives are not without risk. Huge losses can occur with even a small change in the price of the asset the derivative is based upon. Although usually based on a monetary asset, derivatives can also be based on any product agreed upon by the two parties. Derivatives today are based on a wide range of transactions, from wheat prices and gold to even the weather.
So next is the other fee-generating activities. This is the commercial banks engage in another fee-generating activities that cannot be easily identified from analyzing their own and off-balance sheet accounts. These include trust services, processing services, and correspondent banking. Under other fee-generating activities, we have the trust activities. The Trust Department of Commercial Bank holds and manages assets for the individuals or corporations. Only the largest banks have sufficient staff to offer trust services. Individual trusts represent about one-half of all trust assets managed by commercial banks. Next is the processing services. Commercial banks have traditionally provided financial data processing services for their business customers. These services include managing a customer's accounts receivable and accounts payable. Similarly, bank cash management services.
A correspondent bank is a bank that acts on behalf of another bank, usually a foreign bank. The correspondent bank acts as the foreign bank's agent to perform treasury services, manage foreign exchange, facilitate international trade and finance, manage international investments, and conduct other transactions on the foreign bank's behalf. The correspondent bank then charges for its services. Banks will use a correspondent bank when it is not economically feasible to establish a branch in the correspondent bank's location. For instance, a small bank has one customer that has a number of different overseas locations. Rather than open branches in those countries, small bank contracts Worldwide Bank to act as its correspondent bank in the countries where its customer has overseas locations. This way, small bank keeps its customer and the customer gets its banking needs met. Meanwhile, Worldwide Bank earns fees for providing these services. Additionally, many larger banks perform back-end banking service for smaller banks in the same country that do not have the operational expertise to perform the services. In this situation, the correspondent bank provides services that help the smaller bank comply with newly enacted government banking regulations. Often, the small bank lacks the financial and human resources necessary to set up the systems and infrastructure it needs to comply.
Hello everyone, I am the next reporter of the Commercial Bank Financial Statement and Analysis. So, before I start my topic, the objective of financial statement is to provide information about the financial position, performance, and changes in financial position of an enterprise that is useful to a wide range of users in making economic decisions. Financial statements should be understandable, relevant, reliable, and comparable. So, first thing that I can do is to analyze the ratios of the commercial bank. Ano nga ba ang ratios? Financial ratios play a central role in the quantitative analysis of commercial banks. Bank administrators, shareholders, and financial analysts use financial ratios to evaluate the financial characteristics of bank activities such as solvency and performance. And explore the financial characteristic of commercial bank activity captured in ratios and examine the stability of financial characteristic over time. Financial ratios are acceptable tool for analyzing a firm and its performance over time. They have 5 types of ratios. First, profitability, liquidity, activity, debt, and market. Profitability ratios measures the firm's use of its assets and control of its expenses to generate an acceptable rate of return. Liquidity, availability of cash over short term. Activity, also called efficiency ratios, measure the effectiveness of a firm's use of resources or assets. Debt ratios measure the firm's ability to repay long-term debt. Market ratios are concerned with shareholders' audience. Before that, what is income statement? Income statement is one of the company's core financial statements that show their profit and loss over a period of time. The profits or loss determined by taking all revenues and subtracting all expenses from both operating and non-operating activities. An income statement is an important financial statement as it shows the overall profitability of a company. You can also use the income statement to analyze how efficiently your business is able to translate expenses into revenues. Furthermore, it reports company's financial performance over the course of an accounting period, typically a month or quarter. Basically, it starts with the money a company earns and subtracts out the cost of running the business to get the company's profit or loss. Next, direct relationship between the income statement and the balance sheet. The balance sheet and income statement are both important documents to business owners everywhere. The income statement and balance sheet of a company are linked through the net income per period and the subsequent increase or decrease in equity that results. When a company has a strong income statement, it will usually have a good balance sheet, but it is possible for one of them to be weak while the other is strong. We have a timing, performance, reporting, usage, and creditworthiness. When we say timing, the balance sheet shows what a company owns or assets and owes liabilities at a specific moment in time, while the income statement shows total revenues and expenses for a period of time. Performance, the balance sheet doesn't show performance, that's what the income statement is for. Reporting, the balance sheet reports assets, liabilities, and equity, while the income statement reports revenue and expenses. Usage, the company uses the balance sheet to determine if the company has enough assets to meet financial obligation. The income statement is used to evaluate performance and to see if there are any financial issues that need correcting. And last is the creditworthiness. Lenders use the balance sheets to see if they should extend any more credit, but they use the income statement to decide on whether or not the business is making enough profit to pay its liability. So next is financial statement analysis using a return on equity framework. Ratio analysis allows a bank manager to evaluate the bank's current performance, the change in its performance over time, time series analysis of ratios over a period of time and its performance relative to that of competitor banks, cross-sectional analysis of ratios across a group of firms. When we say time series analysis, analysis of financial statement over a period of time, and cross-sectional analysis, analysis of financial statement comparing one firm with others. Return on equity is a measure of the profitability of a business in relation to the equity. Formula of ROE. ROE equals net income divided total equity capital. Next is return on equity and its components. Components of ROE. Equity multiplier is measure the extent to which assets of the FI are funded with equity relative to debt. The formula of equity multiplier is total assets divided total equity capital. Profit margin measures the ability to pay expenses and generate net income from interest and non-interest income. The formula of profit margin is net income divided total operating income. The last component is assets utilization, measures the amount of interest and non-interest income generate a dollar of total assets. The formula of asset utilization is total operating income divided total assets. Return on assets and its components. Return on assets is a type of return on investment. It is most commonly measured as net income divided by the original capital cost of the investment. The higher the ratio, the greater the benefit earned. Metric that measures the profitability of a business in relation to its total assets. Components of return on assets. Profit margin. As stated, profit margin measures as a bank's ability to control expenses and thus its ability to produce net income from its operating income or revenue. Next is assets utilization. The assets utilization ratio measures the extent to which the bank's assets generate revenue. Other ratios. A number of other profit measures are commonly used to evaluate bank performance. Three of these are the net interest margin, the spread, overhead efficiency. So the net interest margin is difference between interest paid and interest received, adjusted for the total amount of interest generating assets held by the bank. Next is the spread, the difference between lending and borrowing rates. The last is overhead efficiency, a bank's ability to generate non-interest income to cover non-interest expenses. A summary of commercial bank financial statement and analysis. These chapters analyze the financial statements of commercial banks. The assets, liabilities, and equity capital were described as they appear in the balance sheet. The financial statement of others, such as savings banks and credit unions, take a similar form. The income and expense.
The Chapter 13 Regulations of Commercial Bank. In this chapter, we provide an overview of the regulations imposed in commercial bank. First, the types of regulations and the regulator. Under of this is the 6 types of regulations seek to enhance the net social benefits of commercial bank service in the economy. First type of regulations is the safety and soundness regulations. It is a layer of regulations have been imposed on commercial bank to protect investors and borrowers against the risk of failure. Second is the monetary policy regulations. It is the regulators control and implement monetary policy by requiring minimum level of cash reserves to be held against commercial bank deposit. The third one is the credit allocation regulators. The regulations such as the commercial bank leading to socially important sectors such as housing and farming. The fourth is customer protection regulations. It is the regulations are imposed to prevent the commercial banks from discrimination or discriminating unfairly in lending. 5 is the investor protection regulations. It is a law. Laws protect investors who directly purchase securities or indirectly by investing on pension or mutual funds. And last, the entry and chartering regulations. It is the regulations limit the number of commercial bank in any given financial service. Under of the safety and soundness regulation, there have a layer of regulations. First is the diversify asset, which loans, investment, and cash. Diversify asset is known as the most obvious way to prevent failure of commercial bank. Although these regulations may result lower probability, also lower credit and liquidity, and ultimately lower the risk of insolvency. Next layer is the guaranteed fund. It is given to those depositors in the time of commercial bank is in trouble. The third one, or the third layer of regulations, is the hold sufficient capital. It is the, for example, meron kang isang store na kung saan, kumbagay, kung ang capital mo is malaki, mas magkakaroon ka, kung magkakaroon ka ng chance na mag-prevent yung risk na makakaharap mo, like liquidity. It is the higher the proportion of capital contributed by owners, the greater the protections against insolvency risk for liability claim holders such as depositors. Next is the last layer of regulations is the regulate by monitoring and surveillance. For the word monitoring and surveillance, the commercial bank always look at time to time to their financial statement or in the report. Next is the net regulatory burden. The difference between the private cost of regulations and the private benefits for the producer of financial service. First is the private cost. Private cost is used in daily operation or the operation of the banks or the firm. The private benefits, it is the money, or it is money that used for insurance or for certain benefits. The 2010 Wall Street Reform and Consumer Protection Act, naglabas sila ng 5 under of this customer protection. First is they promote robust supervision and regulation of financial firms. Second, they establish comprehensive supervision of financial market. And the third is they protect customer and investors from financial abuse. Also, provide the government with tools it needs to manage financial crisis. And the last, rise international regulatory standard and improve international cooperation. Okay, the monetary policy regulations under of this, the outside money and the inside money. Outside money, that part of the money supply directly produced by the government or the central bank, such as notes and coins. It is for deeply understand, it is the money that directly produced or created by bank or central bank and the help of government. While the inside money is a part of money supply produced by the private banking system. For example, it is some money that nanggaling siya sa depositors na nakay bank, which is yung pera na nakay bangko na nanggaling kay depositor, yun yung tinatawag na inside money, which is the liability ng bank to the depositors. Next is the regulatory responsibilities. Ensuring that commercial banks are operate in accordance with regulations. Discussed above that the vital service provided by this institution are carried out safely and in a sound, efficient manner. They have the key regulators of commercial bank. First is the Federal Deposit Insurance Corporations, known as FDIC. It is an independent federal agency ensuring deposits in United States bank in the event of bank failures. Next regulator are the Office of Comptroller of Currency or OCC. It is the chartering, regulates, and supervises all national banks and federal savings associations as well as federal branches and agency of foreign banks. It is an independent bureau of United States Department of Treasury. Second to the last is the Federal Reserve, the FR. It is created by the Congress to provide the nations with a safer, more flexible, and more stable monetary and financial system. And last, the state bank regulators. State bank regulators are responsible for chartering, licensing, and supervising state chartered bank and non-bank financial service provides, including mortgage lenders. Next is the Universal Financial Institution, an financial institution that can engage in the broad range of financial service activities. Um, we have the commercial banking and the investment banking. Commercial banking is the banking activities of depositing, taking, and lending. It is a bank that only offer to for for only depositing and um, borrowers only, while the investing banking is the banking activity of underwriting, issuing, and distributing security. It is a bank that they offer um, by selling and billing the new issue of stocks. Next is the Section 20 affiliate. A security subsidiary of a bank holding company through which a banking organization can engage in invest banking activities. Next is the non-bank bank, a bank divested by its commercial loans and or its demand deposits. The example of this is the insurance firms, the currency exchange, and some micro organizations and pawn shop. The regulatory factor impact geographic expansion. First is they have three: the restrictions of interstate banking by commercial bank. They have an unit bank with a single office. The restrictions of interstate banking by commercial bank with multi-bank holding company with which have multiple offices with parent company, together with grandfather subsidiaries with prior to law. The one bank holding company with a single office with parent company. The last is the Regional Interstate Banking and Branching Efficiency Act of 1993. The last is the disintermediation, the withdrawal of deposits from depository institution and their reinvest elsewhere. It is the reduction in use that intermediate between producer and the customer. For example, investing directly to security market rather than through bank. Imbis na mag-invest muna sa company to use it to buy a stock, pero nag-direct ka na lang sa pagbili ng stock na hindi mo na siya, yung pera, hindi mo na siya dinaan sa bank. The regulator forbearance, a policy of not closing economically insolvent depository institution but allowing them to continue in operation. It is the regulator allowing the commercial bank or the bank to operate continue operations and not closing economically insolvent. And that's all. Thank you.
So, regulations on commercial banks' liquidity. Holding relatively small amounts of liquid assets exposes a commercial bank to increased illiquidity and insolvency risk. Excessive liquidity can result in a commercial bank's inability to meet required payments on liability. So, these claims such as deposits and withdrawals. Moreover, it can lead to contagious effect that negatively impact other commercial banks. So, ang ina-explain po nito ay kapag ang bank or any other firm ay hindi na kayang suportahan ng mga kailangang gampanan na bayarin or obligation of payments. So, this may lead into failure risk. And consequently, regulators impose minimum liquid assets requirements on commercial banks. These requirements differ in nature and scope of various commercial banks. The requirements depend on illiquidity risk exposure perceived for the commercial banks type and other regulatory objectives that relate to minimum liquid asset requirements. So, this one, iba't iba po ng regulation. Depende sa risk exposure ng isang bangko. Doon po nagdedepende ang scope and various regulations of commercial banks. It depends on the damage. Okay, it talks about the damage or the risk failure of the bank. And we have here the regulations on capital adequacy or what we call the leverage. So the FDICA of 1991 requires banks to adopt essentially the same minimum capital requirements. Relative to their assets, some minor differences exist, but the capital requirements for the two industries have essentially converged. And a minimum capital ratio effectively constrains the leverage of commercial banks, since highly leveraged commercial banks may be prone to credit, interest rate, and other shocks, and that thus to the risk of failure. We concentrate on the recent evolution of capital requirements in commercial banking. So, the more highly leveraged ang isang commercial bank, mas mataas ang risk na maging failed or there is a high risk failure. It can be prone sa maraming utang, mataas na interest rate. So, we have here the two different capital requirements. The first one is the capital to asset ratio. And the second one is the capital-based risk-based capital ratio. And it is subdivided into Tier 1. When we say Tier 1, it is the capital risk-based ratio and the total capital. Tier 1 plus Tier 2 capital risk-based ratio. And when we say the capital to asset ratio, it measures the bank's book value of primary core capital to the book value of its asset. The lower the ratio, the more highly leveraged the bank is. So, when we say the capital to asset ratio, dito po nasusukat ang isang book value ng isang bank or ng isang kumpanya. And it talks about the assets. Okay, we're just going to focus here in asset. So, the lower the ratio, the lower the capital ratio of the bank or the firm, the highly leveraged the bank is. Okay, and for the next one, we have the formula. The formula for capital to asset ratio or what we call the leverage ratio is equals to core capital over asset. So, ano nga ba yung core capital? Yung core capital po ay yung bank's common equity or the bank value plus qualifying cumulative perpetual preferred stock. So it talks about book value plus preferred stocks and plus minority interest rates in equity accounts. And we have here the coverage. If the capital to asset ratio is equal to 5% or higher, it means the firm or the bank is well capitalized. And if it is equal to 4% or higher, it means it is adequately capitalized. And if it is equal to or less than 3%, it means it is undercapitalized. And if it is equal or less than 2%, it means, nasa alanganin na, it is critically undercapitalized. Unfortunately, syempre nagkakaproblema daw po sa leverage ratio because it measures the adequacy. So it occurs the three problems. The first one, it is the market value. Even if DI is close when its leverage ratio falls into 2% or less than 2% book capital to asset ratio, it could be consistent with a massive negative market value net worth. So liquidation value of the bank's asset is less than the market value of its liabilities. There is no assurance that the depositors and regulators are adequately protected against losses. Okay, so the first problem is the market value. So even though the capital to asset ratio, if it is false under the 2%, di ba po when you say less than 2%, we have here yung sinabi ko kanina na coverage. That is what we call critically undercapitalized. So meaning, hindi na maganda yung takbo ng assets or the operations of the bank. Okay, so yun po ang nagiging main problem. Or it is less than 2% book capital to asset ratio could be consistent with a massive negative market value net worth. So, ayun nga, kapag nag-reach siya ng 2%, maapektuhan yun yung market value or net worth ng isang company or ng firm. We have here the liquidation value of the bank's asset is less than the market value of its liabilities. So, syempre, kapag gano'n na nangyari, wala nang assurance, wala nang safety na yung mga depositors or your investors ay may hawak pang protection para dun sa mga losses. And for the next one, we have the asset risk. By taking total asset as a denominator of the leverage or capital to asset ratio, falls to consider even partially the different credit interest rates risk of the asset that comprise the total assets. And we have here number 3, the off-balance sheet activities. Despite the massive growth of banks, off-balance sheet activities and their associated risk, the leverage or capital to asset ratio does not consider these activities. So, yung capital to asset ratio daw ay hindi po kinoconsider yung growth ng activities when we talks about the balance sheet. Okay, because the capital to asset ratio, it talks about only the total assets. Okay, so we have here the risk-based capital ratio. Considering the weaknesses of the simple capital to asset ratio, in 1998, the USDI regulators formally agreed to create with the members of the different countries in the Bank for International Settlement o yung tinatawag na BIS to implement the 2 new risk-based capital ratios for all commercial banks under their jurisdiction. So yun nga, lack of abilities, maraming weaknesses ang capital to asset ratio. Dito nabuo yung risk-based capital ratio. This is an agreement sa ilalim po ng mga members ng BIS or the Bank for International Settlements. So sila po yung under their jurisdiction. And let's talk about capital. A capital was divided into Tier 1 and Tier 2. Tier 1 is primary core capital. It is what we call primary core capital. And Tier 2, it is the supplementary capital. The total capital that the bank holds is defined as Tier 1 and Tier 2 capital less deductions. So, the overall capital na hinahawakan ng isang bangko, yun ay tinatawag nating Tier 1 and Tier 2 capital. Tapos, ilalas na dun yung deductions. Okay. Let's focus on Tier 1 capital. When you say Tier 1 capital, it is closely linked to a bank's book value of equity, reflecting the concept of the core capital contribution of the bank's owners. So, dito pumapasok yung equity ng bawat isang owner ng isang bangko. The bank's book value within its owners. And Tier 2 capital is a broad array of secondary capital resources. It includes a bank's loan loss reserves, up to maximum of 1.25% of risk-adjusted assets plus various convertible and subordinated debt instruments with maximum caps. So, dun sa Tier 2, dito na pumapasok yung mga losses. Even if it is 1.25% risk-adjusted assets. Okay, dito na pumapasok yung loss reserves ng isang bangko. And we have here the risk-adjusted assets. It represents the denominator of the risk-based capital ratio. Two components comprise risk-adjusted assets. Kasi yung formula ng the risk-based capital ratio ay over, ang denominator nila yung risk-adjusted asset. So we have here the risk-adjusted asset na meron siyang two components. Ang first component ay risk-adjusted on balance sheet assets. And number 2 is risk-based adjusted off balance sheet asset. So, to be adequately capitalized, a bank must hold a minimum total capital, Tier 1 core capital plus Tier 2 supplementary capital. The risk-adjusted ratio of 8%, that is its total risk-based capital ratio, is calculated. So, ang formula po ng total risk-based capital ratio is total capital, yung total capital, it includes the Tier 1 plus Tier 2 minus deductions over risk-adjusted assets. And when we say Tier 1 core capital ratio, it equals to core capital. Remember, core capital, yun yung Tier 1 over risk-adjusted assets. Okay, lagi po siyang over risk-adjusted assets. Okay. So, we have here, that is, of the 8% total risk-based capital ratio, a bank must hold a minimum of 4% in core primary capital to be considered adequately capitalized. So, di po dapat pababa ng 4% para malaman natin na adequately capitalized pang isang bangko. Kasi pag bumaba na yun na yung sinasabi natin critically capitalized if it is less than 2%, at kapag naman 3%, yun yung tinatawag nating undercapitalized. So, it should be maintained by 4% and higher and higher. And for the next one, we have off-balance sheet regulations. In the 1980s, increasing losses on loans to less developed and Eastern European countries increased interest rate volatility and squeezed interest margins for on-balance sheet lending risk-adjusted assets. So, however, loan loss reserves are assigned to Tier 2 capital because they often reflect losses that have already occurred rather than losses or insolvency risks that may occur in the future. So, yung off-balance sheet regulation, ito po yung ito po yung nag-show ng loss at the present. Okay. It does not focus on the insolvency risk that occur in the future. It talks about the insolvency risk in the present or right now. And we have here the product diversification activities. With the passage of the Financial Services Modernization Act of 1999, the range of non-bank product activities that United States banks are permitted to engage is now more comparable to bank activities allowed in the major industrialized countries. And we have here the global or international expansion activities. United States commercial banks are expanded into foreign countries through branches and subsidiaries that has been reciprocated by increased entrance of foreign commercial banks into U.S. financial service market. So ito po yung sinasabi na global or international expansion of activities. So for example, dati ay nasa United States lang, nagkaroon sa India, nagkaroon sa Philippines, nagkaroon sa iba't ibang bansa. Nagkaroon na yun yung tinatawag na subsidiaries. The main branch expounded into different branches in different countries. At merong 5 main features have significantly enhanced the powers of federal banks regulators over the foreign banks in the United States. Ito yung 5 main features na nakapag-enhance ng foreign banks in the United States. The first one is the entry. Under the FBSEA, a foreign banking organization must now have the Fed's approval to establish subsidiary branch, agency, or representative office in the United States. The approval applies to both a new entry and an entry by acquisition. And the second one is what we call the closure. FBSEA also gives the Federal Reserve Authority to close a foreign bank if its home country's supervision is inadequate, if it is violates U.S. laws, and if it engages unsound and unsafe banking practices. So, syempre, kapag ang isang bangko ay mina-violate ng laws or hindi na siya adequate capitalized, you have no choice but to close your bank. Okay, especially if you violate the certain law of the countries where you belong to. And the third one, we have examination. The Federal Reserve has the power to examine each office of a foreign bank, including representative office. Further, each branch or agency must be examined at least once a year. So there is examine or visiting of a bank if it is adequate enough to operate. If there's no allegations, there is once a year visit to secure the customers or to secure the safety of the accounts. And for the next one, the deposit taking. Only foreign subsidiaries with access to FDIC insurance can take retail deposits under $250,000. This effectively rolls back the provision of the IBA that gave foreign branches and agencies to FDIC insurance. So, yung sinasabi nating deposit taking. Kasi, kapag ang bangko kasi, syempre, hindi naman lahat nagsasucceed na li-liquidate din yung minsan. So, we have here the subsidiaries FDIC. Kumbaga nga ay merong allotted time or allotted money kung how many percent of your deposit in that said bank. For example, the bankrupt. So, may percentage ka na makukuha. It doesn't mean na lahat makukuha kasi alam ko kasi hindi lahat na nabibigay. Halimbawa, ang deposit mo sa bangko na yun ay 1 million. Hindi mo lahat yung makukuha kapag na-liquidate na yung isang bangko. So, be sure na kapag mag-i-invest ka or mag-deposit ka sa isang bangko, make sure na yung bangko ay nakikita mo na in the future, hindi siya malulugi, hindi siya magbabankrupt. So, that's all.